Right. But basically, guys, tonight, what we're going to be going over is actually one of my favorite, I guess you could say lessons or things to teach. And that is essentially, what is smart money, right? How can we identify smart money in the markets? Why smart money needs to trade the way that they do, right? And now is definitely a great time to grab a notebook if you don't already have one, especially if this is maybe your first time on one of these smart money basic calls. Okay, we're going to be moving fairly quickly here because there's another call in about 50 minutes that personally I'm going to be hopping on for trading some binaries. But yeah, basically, what I want to start out with, is of course. A screenshot, which I'm sure the vast majority of people in here have already seen, right? But just to, kind of put this into perspective, right? These are the top 10 currency traders, right? What we have on screen here. So you can find this on the Forex Wiki. The first thing you'll find when you Google search the top 10 currency traders, this is going to be what shows up, right? And what I really want to just point out to you guys is, of course, the market share percentages that we're seeing for these top 10, institutions, these top 10 currency traders, right? These major banks, right? If you think about it, in a market that moves $6.6 trillion on average every single day, right? JP Morgan, who, their market share as of June 2019 was 9.81% of that, right? That's just shy of $650 billion. Okay. Just shy of $650 billion is being moved on average every single day by JP Morgan alone. Okay. And it gets crazier because if you were to add up all these market share percentages, right, just for the top 10 banks, you'll find a number that's, I believe, just under 65%. I think it's like 64.81% or something like that. You can, actually add it up if you'd like to. But the point is, right, it's pretty obvious who is in control of what the market's doing, right? It's these major banks, these major institutions. This is only the top 10 currency traders, you guys. Take into consideration that there are hundreds of other banks that didn't make the top 10 cut, but that would still be in, say, the top 100, right? So, maybe some other banks are in control of 1% of the market share, right? That's still a very significant amount of money, right? So, this is something just to kind of put into perspective the control. Again, I know the vast majority of people that are watching this probably already have seen a screenshot like this before and, maybe went over this in a previous call, but again, it's food for thought, okay? And when we think about, how these institutional traders actually trade, okay, there's actually a screenshot that I want to bring to your guys' attention, and it's this one right here. Okay, this is a screenshot of one of the MT4s that a major institution was, evidently in control of. This is a $49 billion account that we're looking at. Okay, and what I want to turn your guys' attention to is not so much the big numbers we're seeing on the right-hand side here, right? We can obviously see they're making a decent amount of money from these positions, right? But it's more so I want to focus on the lot sizes that these, this particular institution was playing with. Okay. The smallest lot size that we're seeing here is 80,000 lots. That's $800,000 per pip, you guys. Right. So, when we look at a screenshot like this, right, why is this important? Why is this, significant? Okay. And we'll be coming back to this screenshot in a little bit as well, but understand that these institutions can't just casually press buy or casually press sell. They have to be a lot more strategic in how they're trading, right? If you think about a market, any currency pair, any market that you're trading in, right, there always needs to be someone on the other side of your position. So if I'm wanting to enter, on Euro USD for a buy, right, there has to be someone on the other side, entering at the exact same time a sell position, in order for my position to be filled, right, in order for my trade to actually go through. And it's the same, that stands for everybody that's trading, even the major institutions. So when you look at, a lot size that, is 1 million, right? A 1 million lot sell on gold. Okay. in order for that trade to have actually been placed, right, there would have needed to be 1 million lots worth of buying on the other side of that position. Okay. Now, this is where things get interesting, because if we pull up a chart, right, and we'll break this down together. I have a couple examples that I'll show you guys, but for now, let's just focus on, drawing this out. Okay. So, in a market that's trending sideways, right, we're consolidating, we're creating relatively equal highs and relatively equal lows. Okay. What's happening during consolidation is opinions are being formed, right? People are looking to buy from the support, quote unquote support, and sell from the quote unquote resistance, right? The floor is what we refer to as support. The ceiling is what we refer to as resistance. That's what a lot of retail traders are taught, right? Buy low, sell high. Okay. But think about it. For everybody that's looking to take a sell from this area in the market, right? If they're anticipating the market to fall from this area, okay, their stop loss, right? Where's their stop loss going to be? Right? Probably somewhere above the equal highs, right? There's a lot of what we call liquidity sitting above this area, right? Which we always like to kind of, throw on that dollar sign to represent, right? Now, not only are stop losses up here, right, but also perhaps take profits. Anybody that was buying down here, maybe they are targeting for price to break through the resistance. Maybe we have some take profits up here as well. Okay. And in addition to that, maybe we have people that are looking to enter into the market after we've broken through this area. Maybe they're anticipating price to just continue going higher after we've broken through this quote unquote key area of resistance. Okay. So, really think about it. When we look at a chart, right, and we're seeing candlesticks, right, that's, basically just symbolizing trades that have already taken place. What then, you can then take this to a next, kind of next level, right? And that next level is identifying, okay, where are trades sitting that haven't yet been activated? Where are the pending orders? So again, for, just focusing on individuals that might be looking to sell from this area, right? If you're selling, okay, and this might be a breakthrough for some of y'all that are watching this right now, okay? Understand that regardless of what position you're in the market, whether it's a buy, whether it's a sell, you have to do the opposite of what you did to get into that trade when you're ready to get out of that trade, right? So if I'm in a buy, regardless of whether that trade ends up hitting my stop loss, my take profit, maybe I just manually close it, right? If I'm in a buy position, I have to sell in order to close my trade, right? And it's the same thing vice versa. If I'm going to sell, I need to buy back, that position in order to close the trade. Okay. So for anybody that's selling from this area, right? Retail sellers, right? The retail sellers are entering in the market at this, this area of equal highs, right? We're going to have stop losses sitting above this area, and that's going to be seen as a buy stop order. If you're entering a sell, right, maybe your take profits down here below the lows and your stop loss is above, these equal highs. Okay. Either way, take profit or stop loss, if you're in a sell position, it's going to be in a form of a buy stop order. Okay, so we have an accumulation of buy stops. We'll put that S on the end here for plural, right? Buy stops are accumulating above this area. People that are looking to, get into the market, if they're anticipating the price to continue rising, they would have buy stop orders sitting above this area to be entered into the trade, right? But then also anybody that's selling, right, stop losses would be up here in the form of buy stops as well. Okay, to automatically take them out of that position with a small loss, right? So it's the same thing vice versa. People that are buying from the lows here, right, their stop losses are going to be accumulating down here as sell stops, right? Because if you're in a buy, right, you have to sell in order to close that position, right? You have to do the opposite of what you did to get into the trade when you're ready to close the trade. Right? It's the same thing, as above, so below. Okay. So Now let's talk about, and we'll put this down here, retail buyers. Okay. Let's talk a little bit about, how the institutions will play, right? Because according to even just what we have on screen right now, right, I'm sure you guys are starting to maybe connect the dots here. But just to further put some icing on the cake here, we can also look up chart patterns. That you type in chart patterns, you'll get just shy of 700 million results in half a second on Google, right? This is how the vast majority of people are learning how to trade, according to these screenshots, according to information that you can find on a website like Baby Pips, right? If you haven't looked at the Baby Pips website before, right? Baby Pips is a full-on free course teaching people how to trade according to retail concepts without even covering, this kind of ideology that we have of smart money, right? The major institutions, the major banks. Okay. So if the vast majority of people are, trading according to the same kind of style, right? I'm not sure if you guys have seen these types of screenshots before, right? Reversal chart patterns cheat sheet. Okay. Double top, double bottom, right? Head and shoulders patterns, right? This might be brand new for some of y'all that are on this call right now. Maybe you've never seen this in your life, and it's probably a good thing, right? I'm gonna be real. It's probably a good thing that you haven't seen this. Okay. It's not necessarily a bad thing if you have, right? But it's understanding that the vast majority of traders learn to trade according to the same concepts, meaning that for major institutions, that's very easy to take advantage of. It's very easy to manipulate how the vast majority of people are trading. Okay. So again, if we come back to the screenshot here, right, with these major orders, right, 80,000 lots being the smallest position, on screen here, right? Again, they can't just casually press buy or sell. They have to be strategic as to how they're entering the market. So if we come back to this screenshot real quick, or not screenshot, but back to the chart, okay? We understand that there's buy stop orders sitting above the highs. There's sell stop orders sitting below the lows, okay? People's stop losses, right? People that are looking to enter into the market when these quote unquote key areas are broken through, okay? What the institutions will do is they'll hedge the market, okay? When price is at a high point like this, understand this for a second, right? People are taught to sell high, right? So there's going to be individuals that are selling from this point, making it very easy for the institutions to press buy, drive the market higher, okay? Taking out retail stop losses to then enter an even bigger sell position and drive the market lower. Okay. So, just to kind of label this, right? Let's say that this is a 500,000 lot buy that the institutions take, right? This 500,000 lot buy, they only have to press buy once. Okay. As soon as they press buy, this candlestick, right, what it's going to do is it's going to start moving. It's going to start moving. It's going to start moving. And what's going to happen is price is going to reach this area and start triggering people's stop losses, which are buy stop orders, adding to what? The buy pressure that the institutions essentially just initiated. Okay. So this green, candle that we have, on screen here, right? The institutions only had to press buy once at the open of the candle, and price did its thing. It started to trigger all of these retail stop losses. These retail stop losses are being triggered, adding to the buy pressure. Okay. Now it's no problem for the institutions to go ahead and enter what they were really truly wanting to enter initially, which was, say, a 1 million lot sell, right? Because the market was at an area where, we had quote unquote resistance. A lot of people were looking to sell from this area. There wasn't enough liquidity. There wasn't enough orders on the other side of that institution's 1 million lot sell at this point in time, which is why they needed to sacrifice a 500,000 lot buy just to then get into that 1 million lot sell. Does that make sense? Let me know in the chat if that makes sense. Drop a 1 if that makes sense, right? What they're having to do is hedge the market. They're buying to then sell. Okay. Now, the thing that's really, really important to understand here is that when they get into that 1 million lot sell from the high point in price here, as the market's going lower, they're making a ton of money from that sell, right? They're making a ton of money from that sell. But the thing that a lot of people don't necessarily understand is that, yeah, they're making a ton of money from the sell, but the buys that they took here are still open and in drawdown. If you're in a buy position, but the market's going lower, you're losing money, right? You're in drawdown. Now, instead of the institutions, right, if price is down here, okay, you know, however many pips that is, we'll say it's 100 pips. So they're caking on that 1 million lot sell. That's $10 million per pip, right? 100 pips, you do the math, that's a lot of money, okay, right? But for the 500,000 lots that they had in buys, they're in drawdown 100 pips right now, okay? If we go back to this screenshot, let me ask you guys this, and y'all respond in the chat. I like to be interactive on these calls, okay? If you're an institution and you have a position that's in the negatives, $26,775,000, right? Does it make sense for you to just take that L? Yes or no in the chat. Does it make sense for you to close out this position with just shy of a $27 million loss? Right? I'm getting a ton of no's in the chat, and you're absolutely right. No, right? Why close a trade when you're down $26 million when you can wait for the algorithm, right? Which these institutions are in control of, by the way, right? Wait for price to come back to that area where you pressed buy to then break even on the buys that you took back here to then continue driving the market lower, right? Instead of taking that $27 million L down here, what the banks will do is wait for price to come back to their area, right? And they'll sometimes enter orders in order to make that happen, right? Take buy orders down here to continue driving the market higher into this area where they initially pressed buy. And then as soon as price gets there, right, what we always do with these FU or institutional candles is we'll mark them up at the open and the 50% of the candle. Because take this into consideration, right? If institutions are, entering a 500,000 lot buy over here, right? Again, they're only having to press buy once. So the market's going to, do its thing. It's going to, the candle's going to spike up, whatever, trigger stop losses, right? It doesn't make sense for the institutions to have pressed buy anywhere above the 50% of the candle, right? Because if they did, the price would have just continued going higher, right? So we always mark the first, the open of the candle and the 50% of the candlestick. This is where we will anticipate price to come back to, allowing the institutions to break even on their 500,000 lot buy here and then continue to drive the market lower. Because take this into consideration, right? If the banks have a 500,000 lot buy here, okay, what do the institutions have to do here to close their position? Somebody let me know in the chat. They're in a 500,000 lot buy. Price comes back to that area where they can then break even. What do they need to do here to actually close that trade? Does anybody know? Sell. Exactly. 500,000 lot sell. Perfect. Right? They're going to have to close out that position, right? Adding to the sell pressure in the market, right? They don't even need to take any positions. All they have to do is close one and it's going to add to the sell pressure. Okay. So hopefully this is, providing you guys with some breakthroughs, right? Because understand, institutions will bring price back to that area, close out the 500,000 lot buy, which is going to add by default to the sell pressure. And in addition to that, they'll probably take a couple more sell positions when price is in this area. So now not only are they caking from the initial 1 million lot sell that they took up here, right? Maybe they added another one right here after having, or maybe before even closing out that 500,000 lot buy, right? Market continues going lower. They're caking. They're making a ton of money, right? So the terminology that we use for this, and this is something you'll definitely want to write down, when price comes back into this area where they initially had pressed buy from, right? This is what we call mitigation. Write this down, mitigation, okay? And I'll bring up the actual, Google definition of what mitigation is here in a second, right? But understand that, again, the institutions essentially temporarily sacrificed capital over here, right? To then get into that bigger sell position, right? And then they're patient. They wait for price to come back to that area, break even on their 500,000 lot buy, losing literally nothing, right? To then continue driving the market lower, allowing them to make even more money. Okay. So mitigation, let's look this up on Google real quick, right? Mitigation definition, geography. Oh, never put that into Google before, right? So, this isn't the one that I was exactly looking for, but it essentially says the same thing, right? It's reducing risk of loss, okay? It's the action of reducing the severity or seriousness of something, okay? So instead of losing that 27 million like we were talking about, right, they reduce that loss to maybe only $1,000 or maybe nothing. Maybe they lose nothing and they're actually breaking even on their trade, losing absolutely zero. Right. So that's what mitigation means. And that's what we'll, a lot of the times look to, then take our entries according to, right? Because if we understand that when price gets back to this area, right, and they're closing out that 500,000 lot buy, we're going to see 500,000 lots at least of sell pressure, giving us that initial reaction from that zone. So what we'll do is, smart money traders, right? People that are trading according to this understanding is we will take sells from these areas where these areas where the banks are breaking even, right? So, now after we've, kind of broken this down, hopefully this is making sense, right? Another thing just to kind of show you guys is an order book, okay? We'll take a look at, let me see if I can find the picture here. Right, an order book. So this is what we call an order book. And an order book is essentially, what's going to be symbolizing or showing you the pending orders on either side of the market. Now, this is information, guys, you got to take into consideration. You and I don't have access to this, right? As Forex traders using MetaTrader 4, we do not have access to this information. These are the pending buy orders. These are the pending sell orders. Okay. But the institutions, the brokers, the ones that are allowing us to actually trade using their platforms, they get to see this, right? So all the liquidity, all the pending orders that we have sitting above the highs, sitting below the lows, they literally can see that, right? They have access to that information. Now, what's interesting as well, this is what I like to refer to as insider trading. Let's look up the penalty for insider trading. Okay, the penalty for insider trading. This is according to the SEC. It's a little bit outdated, 2013, but nonetheless, right? Penalties, sanctions. Okay, the maximum criminal fine for individuals is now $5 million, right? And I believe it's the maximum prison sentence is 20 years. Okay, so take this into consideration. If you're working at Tesla and you knew that the Tesla truck, I can't remember what it's called, right? Some of y'all are probably thinking back to when this actually happened. There was a beautiful sell to buy on Tesla stock right before they announced the Tesla truck. Okay, so let's say that you worked for Tesla and you knew that the truck was coming out before the entire world knew, right? So you went ahead and you bought up a bunch of Tesla shares, right? If you got caught for doing that, okay, this is what you would be subject to, a maximum, of 20 years in prison and a $5 million fine. Okay, so explain to me how it's fair, right, that the institutions have access to information like this, right, and get away trading, understanding where the money really truly is and pending orders, and don't get in shit for it, right? He who controls the money controls the world, right? When you really think about it, obviously there's not an even playing field when we talk about trading. It's just very, very interesting to me how, essentially these institutions get away with insider trading every single day in the market, and, rest assured knowing that they don't have to worry about any sort of consequence. Now, don't get me wrong, there have been cases where major institutions will be fined. You know, I think there's a couple you could probably find on Google, a couple cases where certain institutions got fined or whatever for you know, manipulation, right? Forex manipulation, what have you. But it's pennies on the dollar in comparison to what they're making, right? So now that we've kind of broken this down, right, we have around 20 minutes left on the call. Let's just take some time to go ahead and you know, dive into some examples of, you know, where this has happened, right, in the past. You know, just to kind of further put this into perspective, right? So, you know, the first example that we'll take a look at here is USD JPY. This is an example that happened actually this week. Okay, so very, very recent. And you know, if we take a look at, you know, say the 15-minute time frame, right? I want you guys to just take note of, you know, what's happening in this area. Okay, we have, you know, consolidation, right? Choppy price action. Okay, this is an area where a lot of opinions are being formed, right? You have relatively equal highs, relatively equal lows. Okay, so anybody that's looking to, you know, say sell from this high point, which we touched once, twice, 3 times, 4 times, 5 times, 6 times, a ton of different times, right? This quote unquote resistance area. We can even, you know, extend this a little bit farther back. Okay. Any sort of retail trader that's looking to sell from this area is likely going to have their stop loss above the highs. Okay. So maybe it's above, you know, this wick right here, right? You guys can kind of see the wick that we have. Maybe their stop loss is above that wick, which, let me see if I can mark this up here with a red. Okay. Maybe their stop loss is there, right? Now, again, institutions have to buy to sell and sell to buy. So if we play out price action here, what you guys will notice is price spikes up, and then we see a pretty significant sell-off immediately afterwards, right? This is that example of the institutions, right? We'll go to the 30-minute time frame just to get a little bit more clean with this, right? There's that temporarily sacrificed buy, right? That FU candle that takes out all the retail stop losses, all the buy stop orders above this area, right? To then allow the institutions to get into, say, that 1 million lot sell that then drives the market lower, also taking out the liquidity down here, right? So again, this is that perfect example, if you will, of how the institutions will buy to sell, right? And if we take a look at this candlestick, right, what do we like to mark up for this? Okay, we mark up the open of the candle, which will be at the bottom, since this is a buy candle that we're looking at, right? Mark up the bottom and the 50% of the candlestick. Okay, so more or less, you know, we just eyeballed that, but something like this. Okay, and what we'll look to do, right, or what the institutions will look to do is mitigate from the buys that they took in here within this area. So this is what we call that mitigation zone or mitigation area, right? And what we can anticipate is price to get up in here, not stay here for very long, and then continue selling off, right? So as we play out price here, you guys will see that, you know, price gets up into that area, and then what do we see? Another significant move to the downside. Okay, so not only did the institutions enter, you know, 1 million lots worth of selling here, right? They also potentially stacked sell orders here when price made this retracement, right? This is an expansion to the downside, retracement. Now we're seeing another expansion. Okay, they added sell positions and broke even on the, you know, buy orders that they had within this blue candlestick. Right. So this is that exact same, you know, basically example of what we were just covering, you know, as we were, you know, when we were just drawing it out. Okay. So this is an example of, you know, a sell, right? Buy up to sell down, price comes back, they mitigate, continue marking price lower. Okay. So let's look at a buy example, right? So the same thing, but vice versa. And this is from This is an example on AUD CAD from a couple weeks ago. I did call this out for the entire squad, back in earlier this month, right around the 14th of September, I believe. But if we take a look at this, right, we already kind of have it highlighted. But what we're seeing is, right, if we go ahead, we'll go full screen for this. Okay. So first thing I'm going to identify is, relatively equal highs here. Okay, we have high over here. This almost touched right there. Another high right here. And we also have relatively equal lows down here. Okay, so for anybody that's, a retail trader, they're likely looking to buy from this area of quote unquote support, right? So we have, again, retail stop losses below this area, right? And as we play price out, we'll see that we get that push down, triggering retail stop losses, taking out this area of equal lows as well. And then we get a nice impulse to the upside, where we then created another area of relatively equal highs. Okay, so this liquidity was captured. Meanwhile, more liquidity was created at the highs. Okay, we'll put an X for the liquidity that was captured. And this is that example of the institution selling to buy, right? That sell to buy scenario, this FU candle that we have here. Now, how are we going to mark this up? It's the same thing that we did, just vice versa. So you're going to mark up the open of this candlestick. Now, with a sell candle, a candle that marked lower within, that specific time, you're going to mark it from the top and the middle, because we understand that with, sell candles, right, the price mark, or, the market opens, or the candle opens at a higher price and then closes at a lower price than where it opened within, that specific time frame. Okay, so this is how we would then mark up that candlestick. Okay, so the sell orders that the institutions had within this candle remain open even as price marks up. So they're making, a ton of money from the buys that they caught down here, right? But they're still down. They're losing money from the sell. So what's the market going to do? It's going to pull back into that area, right? Again, that mitigation zone, that mitigation area, allowing the institutions to break even on the sells that they had in here, right? Then driving the market even higher. And we'll see that price just runs and completely blows out the equal highs that we had here, right? And, this was a beautiful, beautiful trade. We also had equal highs back here, and those equal highs were taken out as well. Okay. So, with this being said, right, if we're looking to, enter off of these mitigation areas, right, these mitigation zones, whatever you want to call it, right, how can we plan our entries accordingly? Right. Well, if we have this last down candle prior to a push up where then liquidity was created, right? For me, what I like to do is I'll enter off the open of the candlestick with my stop loss below the low. Okay. And the reason for that, the reason why my stop loss is going to be below these two candles over here is because, well, if the institutions did in fact buy, 1 million lots, 2 million lots, 10 million lots, whatever the case may be, in this area, it wouldn't really make sense for their buy position to go into, into the negatives, right? They already have the sell position in the negatives as it is, right? So, it doesn't make sense for their buys that they got within this area to go into drawdown. So stop loss is going to be below the low. My first target would be those equal highs. That's going to give you like a 1 to 2.5 risk to reward ratio. Second target would be above the next set of highs. That's now 1 to 4 risk to reward ratio, right? So, if you risk 1% on this trade, you just made 4%, right? If we go back to, that USD JPY example that we were just looking at, right? It's the same thing, just vice versa. So you're looking to, enter off the, go back to the 30-minute time frame for this, the open of the candle. All right. The open of that candlestick, stop loss above this high over here, targeting, personally, I was targeting the equal lows, right? Just target liquidity, target where you have retail traders looking to enter into the market, right? People are going to look at this as an area of quote unquote support. Why? Well, because price came into it once, twice, 3 times, and we never broke through it, right? But I'm willing to bet that odds are, as price continues marking lower, we'll probably just trash this zone. All the money, all the liquidity below that zone that we have marked is going to get taken out, right? So that would again be another 1 to 4 risk to reward example. And as you guys can continue to, get down these concepts, right, your risk to rewards are progressively going to get better and better, right? For me, I've personally been trading smart money concepts now for about a year, right? A little over a year, probably like a year and a half actually. Okay. And, for some of you guys, it might be your first month, might be your second month, might be your third month, right? Regardless of how long you've been doing this, right? You're going to get better as time goes on. So if you don't necessarily understand, what I went over on today's call, well, number one, this was recorded, so I can hook you guys up with the recording. Okay. Number two, right, I would encourage you guys to ask questions if there's anything you're uncertain on. And number three, right, there's that quote that we always like to use, and that, it goes, right, to know when to not do is what? Right, someone answer in the chat for me. To know and to not do is fill in the blank. To not know at all. Exactly. Right. So take the information that we covered tonight and apply it. Right. Apply it. Yes, Alex, exactly. An FU candle is like a fake out. Exactly. That's a perfect way of, of thinking about it. Right. Imbalance. I don't have time to go over imbalance, but I do have a recording that I can hook you guys up with. If you reach out to me on Instagram or Telegram, I can definitely send that recording your guys' way. I think that'll be, something of value for those of y'all that are wanting some more information on imbalances. As an example for AUD, NZD on the most recent candles, would that be an example of what we just reviewed? Good question. Let's take a look. So what time frame are we talking about, like the hourly time frame? 30 minutes. Okay.
One question.
Yeah, let's hear it.
Yeah. While looking at the higher time frame structure, while entry, we don't confirm in the 5 minutes, 15 minutes, the same structure, breakdown of lower lows.
So time frame, that really comes down to your trading style. For me, I always do top-down analysis. So I'll start
for
on the
more
higher
confirmation, this trade is going to hit.
What's that, sorry?
For more confirmation, don't we look for the lower time frame break of the structures?
Yes, exactly. So if price comes into, an FU candle, and then you're looking at that smaller time frame and you see the smaller time frame break structure, that's a perfect additional confirmation that was in fact an area where the institutions were breaking even on, previous orders. Exactly. Yeah, you got it. So yeah, Dave, this is actually, you could look at this as another example right here too. So, what we had, right? Relatively equal lows. Okay, this low as well, right? I like how there's a number of different wicks right here. What does price do? Sell down. We do come below this wick as well, and now price is marking up. So this is a nice example right here, right? You can see it a bit better on the 15-minute. We'll even take a look at that as well. Right? Yeah, that's perfect. That's perfect, right? So for me, I would be looking at this candlestick and going, okay, cool. I'm going to mark it up from the open and from the 50%. If I were looking to take a position on this, my stop loss would be, below the low, and maybe I'm targeting the high over here, right? looking at AUD NZD, we've been pretty bullish. This is something that I would definitely say is a solid example of what we just kind of covered. You even have the high over here you could target. Whoops. Right. So yeah, good stuff, Dave. This is a perfect example. Perfect example. Right. So yeah, guys, I think I'm going to wrap up the call here. Okay. Hopefully, you guys got some value, maybe got some breakthroughs from the call. It is something that'll take some time to, really solidify in terms of understanding. And I do have, again, more content that I can send your guys' way if you're wanting some more content. But Christian, you already know, man, we gotta sauce it up on these Wednesdays. But yeah, hopefully you guys got some value. Maybe you're looking to take this position, right? This is a solid setup. This is something that I might even look to take myself on AUD NZD. So I might set an alert here and see what's good as the night progresses. But shout out to Dave for that. But yeah, appreciate y'all for taking the time to jump on the call here. There's another call that's starting in about 9 minutes. It's going to be a binary options call. So, feel free to jump on that if you're wanting to learn some more about binary options. It'll be live trading.
Is it live trading session?
What's that, sorry?
Is it live trading session?
Yeah, it'll be a live
binary
trading session. Exactly. Yep. So yeah, y'all stay tuned in the announcements chat. I think the link will be dropped there. But yeah, guys, appreciate y'all. And yeah, any questions you guys have, just feel free to reach out to me on Instagram or Telegram. I'll put my ad on screen here. All right. Thank you, computer, for not.
Please drop your Telegram link.
This is, if you go to Telegram and you search this I'll be the first one to pop up. So that'll probably be the best way to find me on Telegram. You can also search me in the chat as well. But yeah, cool, guys. All right, I'm gonna wrap up the call. Appreciate y'all. Much love. Clap easy this week, and yeah, let's keep grinding, yo. Let's get it.